Eric, welcome to the show.
Thank you. Thank you for having me today.
Yeah, we're very happy to have you. So why don't we start off with a little bit about your company, Onramp Funds. Can you tell me a bit about that?
Sure. We're a working capital finance solution for the e-commerce small business owner, which means we help e-commerce small business owners with really making sure there's always funds available to pay for inventory and then to pay for the advertising that drives inventory sales turnover, and then to pay for the shipping and fulfillment expenses associated with that sales turnover. What we find is that, especially in the small business range, a lot of times most personal capital is tied up in there. And we think that that capital should be redeployed to more growth-oriented tasks, and our capital should sit in there and really just make sure that turnover continues.
Cool. So from your experience, what do you consider the best specific use for financial lending? I mean, we're talking about inventory scaling, a little bit of marketing. Is it that sort of thing, or is it so diverse it's kind of impossible to answer?
Well, I mean, look, there's different financing for different things, right? We are definitely that kind of quarterly financing, right? Mm-hmm. You pay back as you sell, so we're not a credit card with a 30-day term, but we're also not a 5-year equipment lease, right, for a piece of equipment for your warehouse. Sure. And so, what I think is most important around financing in the general sense of it is, it's really important for somebody to understand the structure of the financing they're borrowing, and the intention that the lender had for them in the use of funds. Because if you misallocate money that you borrow from a lender into a task the lender wasn't expecting, their payments are geared around a specific set of expectations that may not be able to be met, right? So if you use my funds for equipment financing, well, that means there's not inventory to sell. And I have this kind of 90-day expected turnover cycle in terms of repayment, but then also, within 45 days, giving you more money, right? Mm-hmm. Whereas if you went and, bought a forklift for a warehouse and you needed 5 years to pay it off, well, hold on, I'm expecting full repayment in 90 days, not 5 years.
Totally.
So the number one thing we see small business owners, when they're challenged with cash flow, is a lot of times they actually have the funds necessary to run the business, is they've misallocated those funds. And so what the Onramp system does is very much align our funds with a specific set of use cases and turnover expectations, so that you always have funds for inventory, for advertising, for shipping. That means the money that you would have tied up in there can be used for other things. And it still means that you can go and get equipment financing, right? Or lease a truck for your business, right? Using the proceeds of your business, because we're not interfering with that. But it helps make sure then that what you're not doing is having funds misallocated in places that might then, prohibit you from doing something else as your business. So we try to be very highly structured and targeted for that working capital problem.
No, that makes a lot of sense. Do you have to kind of hold their hand through that spending process, or do you really just say, here's your money, here's what it's for, don't screw it up?
No, we try to very much coach them through how it works. Now, some of our customers already understand it very, very well. Certainly, by the time you get to your second and third turnover with us, it becomes just second nature, right? Mm-hmm. And it becomes something that our business clients then actually really appreciate, because then they've seen it in action, they've felt it, and they're like, hold on, I never have to worry about this specific problem in my accounting anymore, right? Which is not to say I don't have other problems to solve, but they've now got a solved problem here, and that feels really good, right? And it makes it really easy for us to continue to work together.
Mm-hmm. And what part of what I'm hearing you say there is that you do have multiple clients that come back and kind of double dip, and get more lending with you. So how often does that happen?
So our average customer is staying with us for 2+ years, and they're borrowing kind of every 40 to 90 days and just perpetually turning that over, depending on, time of year, seasonality, things like that. Things accelerate over the Christmas holidays, right? There's so many sales. Sure. Things slow down this time of year, right? And then the way we're structured is your payment cycles with us are tied to your sales cycles. And so if sales decline, the amount you pay us declines. And then as those sales grow, you'll pay us more, but it's a percentage of those sales. And so what that really means then, right, is that the merchant should never feel the pinch to be able to make a payment when they're having in the sales to drive that payment. So the alignment's very, very tight, which then means, if you find yourself in a situation where your credit card processor is holding a higher reserve rate, well, what you're going to pay us is reduced because of that until those reserves get released. And so what we've really done is built an engine that completely aligns with that sales turnover cycle, the sales receipts and deposits of the small business owner, so that we're not putting them in a pinch accidentally, right? So it's really about helping getting them to a much more stable place with turnover and really addressing kind of the cost of goods sold and inventory expenses associated with running these businesses.
Mm-hmm. No, I really appreciate you walking me through that process too. So just to kind of take a step back and start from maybe inception to execution to payment, how easy is it to get a loan with Onramp? Do you mind walking me through that process a little bit?
Sure. Our customers can, in about 10 minutes of their time, be fully they have completed the entire application process, right? So creating an account by, giving us your email and creating a password, connecting your online stores, connecting a bank account, and then providing us the business documentation necessary to validate that you are who you say you are, right, to prevent fraud and comply with all the federal lending regulations. Our fastest loans are out in less than 2 hours. So from sign up to actually, funding, leaving our bank, going to you. Most customers need a couple of days because they actually want to think about the offer before they just say yes. But it's a really pretty painless process. And in fact, you don't actually have to even give us the business identity verification data until you've been fully approved for a loan. We won't deploy funds without it, but we're actually using, bank data. We're using your sales performance data from your Amazon or Shopify or BigCommerce store to make these offers. And so really the hardest part of that process, right, is tracking down your EIN letter, your Secretary of State filing documentation for your business, and your, a copy, a picture of your driver's license or passport. And we actually don't make you do that. Don't ask for that data until we actually know we can loan you the money. And so it's worth taking that additional step, right? Because you're like, oh, hold on, there's $20,000 waiting for me. Yes, I will go spend the next 5 to 10 minutes to track down those documents, upload them via your secure upload folder, so that you can then, complete the identity verification step.
I like that. So what are those specific factors and qualifiers that you look at? That it sounds like you guys work closely with Amazon and WooCommerce. I think Shopify is one of them as well. So if you're kind of only looking at the business, right, instead of the personal, I think I read somewhere you don't look at personal credit history or anything like that either. So what are some of those factors that you're looking at?
Yeah, we're out there looking at, what has your sales performance been historically? And then we're going to build a forecast for what we think your sales will be over the next 3 to 6 months. We're going to look for, do you have sufficient sales, right, that we can build that forecast? Do you have, we're going to look at your banking data, right, transactionally, and see, hey, have you had a problem making loan payments in the past, right? Or, do you have problems with, bank balances, checks bouncing and stuff like that? And really trying to get a sense of just what that merchant's payment history has been, right? And sales history. We can work with merchants who have literally their first 5,030 days revenue. We have a program called Launchpad that we help emerging merchants with. Our core customers are typically going to have at least 6 months of revenue, and underwrite, and we're going to use that revenue trend, right, to then say, hey, great, what's the next 90 days look like, and then probably loan against that 90-day expected revenue stream.
Mm-hmm. And what's kind of the range of the loans that you give out? Because I've heard you throw a few numbers around. Is it 5,000 to what, 200,000? I mean, what's that range look like?
Yeah, we're typically loaning anywhere from $1,000 to $400,000. It's kind of the sweet spot range for us right now. We will be increasing that over time, but right now it's really where we target, right? And that's, we're really focused on working with small business owners with revenues of kind of 10,000 a month to about $1 million a month in recurring revenue. And our sweet spot's probably about 100 to 200,000 in recurring revenue. on a monthly basis. But again, even that Launchpad product, right, where it's your first $5,000 in monthly revenue, we have a product for that emerging class of merchants.
Mm-hmm. No, that's great. I $1,000 is great. I mean, you can kind of stair step your way up if you really needed to throughout the entire process and kind of just be able to leverage this sort of finances. If, say I'm bad with how to spend my money, then it's kind of easier to lend from you guys because you'll tell me what to do with it at the same time. And it's only taken, 1% of sales. So you're still walking away with 99% of that money. According to your website, brands can actually have their cash in hand within about 48 hours from the step-by-step process that I saw after creating an account. So with that money, I try not to presume to know everything, but I'm assuming, let me rephrase that. Is the loan coming directly from your account? Where is the lending money actually coming from specifically?
Yeah, so we're loaning from our bank account and depositing those funds in the merchant's bank account. We do it all via ACH. And the ACH network is not, well, they're adding real-time functionality now, right? But it's typically an overnight network.
Mm-hmm.
And so typically, like when I said earlier that somebody could apply, enroll, apply, request money, be approved, and have funds dispersed same day, it happens. But that typically means that overnight is when the funds will arrive in the client's bank account, right? So it is a pretty rapid process, and then we're going to talk to the merchant about how what our expectations are around the funding is to really help this sales turnover, right? So
Mm-hmm.
we're not funds for you to go buy a truck for your business. However, your personal cash now has been released from cash conversion cycle problems, right? You're not having to use that money for inventory anymore. You can borrow against the inventory you have in stock, which means then your personal funds can be redeployed to those other investments in your business that'll help it grow. And that might just be redeployed into paying your salary. Because if you think about it, a lot of business owners, let's just use a $1 million a year revenue stream as an example, right? If you're generating $250,000 in top line sales every quarter, but let's assume that you need 40% of that for turnover, right? To pay for shipping and fulfillment and advertising and inventory. Well, that means you need $100,000 at the beginning of quarter, right? To have the necessary inventory, then drive the advertising and shipping to create sales. And if it's midway through the quarter, when you need another 100,000 for the next quarter, well, you haven't actually extracted 100,000 in profit yet. And you're actually not going to ever have 100,000 in profit, right? But you haven't had the sales necessary to free up 100,000 in cash for the next quarter. Our cash is there for that, right? And then what we're suggesting to merchants is without us, right? They'll get to the end of the year, their accountant's going to say, "Hey, congratulations, you did $1 million in sales last year, and let's just pretend you had a 10% profit margin, so $100,000 in profit." You owe the IRS for your taxes. But then you go home and your wife or your husband's saying to you, "Hold on, but there's no cash in the bank. We're still eating peanut butter and jellies. We haven't been on vacation, right? We're not putting money away for retirement or for college." And that's because it's captured in that cash conversion cycle. And so what we're doing then is saying, great, release your funds from that, leverage the inventory that you now own, to release your personal capital from having to own $50,000 in inventory. You can borrow against that. You've now freed up your capital, which means you can use that to pay yourself. And so now you can pay your salary while you're using our capital to continually just churning over your sales and inventory. And it's always there for that next round. And because you're paying it down as you sell, essentially the merchant now is paying their cost of goods sold on a per unit basis when they've received the sales receipts for the sale of that unit, not in advance. And so that's the real power of a product like ours is it's highly optimized to help the merchants escape, to get out of that just captured cycle of my money's stuck in inventory and advertising. How do I free it up? Put our money in instead.
Well, and part of what I like there, Eric, that I hear is you're not essentially writing these guys a check to help them get out of a tight spot. Is you're actually, the real value comes from the coaching aspect in empowering the entrepreneurs and the business owners in how to almost like liberate themselves a little bit, it definitely feels more of an empowering process than okay, here's your money, pay us back when you're ready. I really like that empowering piece there.
No, and I think that's the mission, right? Like we want to help more small business owners reach sustainability and reach the scale that they want to achieve, right? And
Mm-hmm.
and that scale answer is different for everybody, but sustainability is the same for everyone, right? Sustainability is I have a business that generates the revenue and the profit margins that I want.
Mm-hmm.
Now, one person's definition of I've reached the scale I want might be 20 million a year in revenue, and somebody else's could be a million a year in revenue. Right, that's not for me to decide. Right, I don't have an opinion one way or the other on that. But what I want to help them do is reach the point where they're at sustainability. And then the reason that we like working with customers for the long term is that once you've done a cycle with us, right, a 30, 60, 90-day cycle with us, and then you do another, you actually then really you've internalized the power of the solution, right? And in theory, right, people can kind of look at it and get it, but there's no escaping the fact that it's always more powerful once you've used a product and actually understood the use because you've been through a full turnover cycle with that product.
Mm-hmm.
Then you're like, hold on, now I get it, right? This really, really helps my business. And it means that I can still go use my credit cards for other expenses. If I want if my business wants to go borrow money from the bank to buy a forklift for the warehouse, right, or something like that, Onramp's not in the way of that. Right, because we're just not structured. We're structured in a way that makes sure that you can take advantage of different types of financing to help scale the business, right? And we're not equipment financing, but then we don't impede that. And by the way, if you have equipment financing, that doesn't stop your ability to borrow from Onramp, right? It's just we're really structured well, and what becomes really powerful, and the reason we have such good repeat business is that the merchants begin to understand that and see the power of it, and then dial us in for what we're best for, so that they can use other financing for what it's designed and best for.
No, absolutely. How often, if you don't mind me asking, are brands unsuccessful in paying back their loan? I imagine it's rare, but I am curious.
Yeah, no, look, every lending business has the unfortunate side to it that there is going to be bad debt. What we see is that it's a pretty infrequent occurrence. And what we really accept in terms of bad debt is, the risk that we're taking on is that your business can't deliver the next, call it 90 days of sales, right? Mm-hmm. And if that means that your business is going under, but you're treating us fairly, right? If we're supposed to be paid 10% of sales every time you get a deposit, if we're seeing those deposits come through, but the business just goes under, then we accept that risk, right? It's our job to build a risk forecasting engine that can tell us that you're going to have the sales necessary to repay us. Now, we do have customers who just decide they don't want to pay. And then, unfortunately, then we have to go through a collections process, right? It's not what we want to do, but if we aren't, if a customer is able to pay, but just decides they don't want to pay, if we don't find a way to get paid, we don't have a business for the other 500, 600, 700 customers that we're supporting. And then we're not supporting the vast majority of good borrowers. Mm-hmm. And so, but, from my perspective, the risk that we're really willing to accept is that your business goes under, right? For some reason, let's face it, small businesses have a failure rate.
Totally.
And it's unfortunate, right? But we're willing to take that risk with you. And if as long as we're treated fairly on the way down, then we're going to accept that was a loss that just, happened, right? And then we're going to refine our risk modeling, right? To say, hold on, why weren't we able to detect that business was going to have that problem in the next 90 days? Right.
I was just about to say the same thing. I mean, bad debt, sadly, good data,
Yeah, and it is good data, and we will refine for that, right? So that hopefully then the next time that we can see that, we can go back to that merchant and say, hold on, you're not ready to borrow from us right now because you have these problems. But if we can spot those problems, then can we actually help the merchant say, hey, great, if you can solve this problem, here are the steps you need to take. And the data is going to reflect that over the next 30 days. And then, by the way, you'll be eligible. Mm-hmm. Well, then we're actually being a partner to that merchant because we're helping them spot that trend maybe before they even recognize it.
Yeah, that's really powerful. I didn't even think about that, you could say, yes, but you have to use it this way, or else your business is literally going to go under according to our forecast modules,
Right.
How long does it typically take for a brand to pay back their loan? So let's say they are. I'm hearing you say 30 to 90 days, something like that.
Yeah, our loans are structured, our advances rather are structured in kind of a 30 to 150 day expected payback period. And it's really customized per borrower based on the unique sales turnover, inventory turnover
Okay.
cycles of their business. So on average, it's about 90 days, right? Which the average inventory turnover cycle for an e-commerce business is about 60 days. So we've got a little cushion in there for you. But when you have customers who go faster, we have a lot of customers who are on kind of 30 to 60 day cycles, and then several that even run a 120 to 150 day cycle. But we work with each of our borrowers, right, to understand that need. We use the data from their sales history, from their inventory history and whatnot, to actually ascertain that. And then we optimize the loan offering against that and any specific requirements that merchant might have for their immediate needs.
Mm-hmm. And just to kind of circle back a little bit, so these businesses, are they essentially making a payment to you at the end of every month or week or whatever, instead of you being hooked up to their business and pretty much taking money off the top until you're paid in full?
Yeah, so the payments are automated, right? So we're connected into their business, and so we automate the payment, and we're determining, when we make the advance offer, we're telling the merchant that there is a certain percentage of each sale, and that, to be clear, at deposit, right? So not you sold today on Amazon, but they're not going to give you the money for 17 days. No, we're going to wait the 17 days. We want to make sure that the cash is coming to you when you make the payment to us. And then, we're determining what percentage of those sales that is. And then we synchronize that with the deposit pace of the different sales channels. So if it's Amazon, it's every 2 weeks. Well, you're going to be making a payment every 2 weeks. If it's Shopify, that could mean that you're making a payment every day, and it's for sales that happened 4 days ago because of the lag between the sale date and the deposit date, right? And then other channels might be weekly. And so then what we're doing is basically saying, whenever you're receiving sales receipts, when those deposits are coming to you, that's when you're making the payment back to Onramp. So you're paying the cost of goods sold. For instance, if you sell this pen, right, and it's sold it for $40, and you're paying us 10% of each sale for the cost of the pen and the fee associated with the loan, well, then great, that $40 is deposited. We're going to sweep the $4, and now you owe $4 less, right? Because you paid it off for that pen. But then let's just assume that all of a sudden you go 10 days without selling a pen. Well, great, you don't have payments in those 10 days because there's been no sales, and so that way we're in sync. And then let's just say you get to day 15, all of a sudden you sell 100 of them. Well, now you're going to owe us $400, but that's because the sales were there to generate that payment.
I was just curious about the exact specificity of that repayment process and what that looked like. What sort of business or product, if there is any, tends to pay you back more quickly? I mean, is there a certain trend that you've noticed where 10 companies tend to pay you back really well or have a great return on lending for you guys, or have you noticed any sort of trend there?
Well, I think, we actually, it's not so much the type of seller will determine the seasonality, right? So, kind of general retail, right? Christmas is your big time of year. It's, people giving presents, right? All that volume comes through. And so that time of year is going to be very fast payback. We have customers who sell seeds and gardening supplies. They're actually in their peak season right now. It just kind of started in the last weeks, right? And so it's less around the type of business that pays quickly. It's more around each business has a different seasonal cycle, and they're going to have times of the year when it's really busy, right? But you don't need to borrow a lot for inventory in October if you're a gardening supply company, because you're 6 months away from anybody buying anything, right? And so, we're going to cycle with that seasonal trend. And then we're also going to look at that business's sales velocity, right? Are they growing? Are they declining? How fast are they growing, right? And then we're going to reflect that with that seasonality and then other kind of macro trends on their sales forecast, and then loan against that, right? And then it's our job to make sure we're getting that forecast right.
hmm Have you seen people do that where they ask for money from you, where they know that they're not going to have money coming in, so that way they can kind of, I don't know, buffer it the way they are? I mean, that's kind of another school of thought. Essentially, it's not like anything necessarily wrong with it. I don't think if it's like, ideally you want to pay back a loan as quick as possible, obviously, but if it's not accruing interest, then there's no real difference between if I have like a bit of a buffer during my downside or downtime of the season versus when business is booming.
Yeah, but let's not forget again, if we know that you're coming into your slow time of year, right?
Mm-hmm.
And you're only going to do, let's just say you're using that $1 million example, right? But Christmas is 500,000, right? And then, or 400,000 in Q1 quarter is 100,000. And then the other two are 250. Well, if you're coming to us in November saying, hey, I need to borrow money for Q1, I'm actually doing that against a Q1 revenue stream of 100,000, not 400,000, right?
Yeah.
And so we're saying, look, yeah, you do need inventory, right? But you don't need $400,000 worth of inventory, because that inventory could become stale and unsellable. And then you're on the hook and we're on the hook. You need 100,000 of inventory because we know that's what you're going to turn over in the quarter. Now, by the way,
Gotcha.
if your Q1 sales accelerate, well, you can come back and borrow again, right? So once you're halfway repaid with us, if we're seeing sales accelerating and you are too, and you're like, hold on, I need more inventory before this inventory runs out, we'll essentially say, hey, great, you now have more available capacity. Your credit line has gone up. You can now draw against that, get additional funds out to keep hitting those growth targets, because we're both seeing the same data.
Mm-hmm.
And then we do have merchants come say, hey, I'm going to go triple my sales next quarter. And we go look at them and say, well, here's what our forecast is. And, unfortunately, you haven't proven that yet. So we can't loan you that triple sales capacity today, but we'll be monitoring every day, right? We see the data come through on a daily basis. And as we're seeing that accelerate, as you prove that, then your available capacity increases, and you can come draw against that so that you're keeping up with that demand.
Mm-hmm. And we're talking a bit about some of the hardships or obstacles that e-commerce business owners have to face. What are some of the broader ones that you've seen in terms of financial challenges that smaller e-commerce business owners have to face in this current landscape?
Yeah, I mean, let's face it. The number one challenge for a small business, and this is true for e-commerce and all small businesses, it's cash flow management, right? And typically, the biggest, if you start to subdivide that, right, the biggest challenge is I don't have enough of it,
Yeah.
right? There's not enough cash. But I will say then the one that follows on that is it's not so much that you don't have enough, it's that you've misallocated funds,
Yeah.
right? And that could be because, look, your forecast was just off, right? And so I bought too many blue pins and not enough red pins, right? Or what have you. It could be that, hey, the bank was willing to give me a 2-year loan. And so I bought a car, but now I don't have money for inventory, right? Or, something like that, where you've really misallocated funds because you weren't used to the structure and kind of the different expectations of different types of funding, right? And so all those things come together. And so, again, that's what Onramp's really designed to help people understand is we're here to keep the business humming, right? But we're not an investment, and we're not a long-term loan where we can say, hey, great, there's a forklift for $20,000. Here's the $20,000 to pay for it, and you can pay us off over 5 years. Right. What we're saying is you need enough pins to sell for this quarter. And then halfway through the quarter, you need to order that next batch. We're here for you for that. And there's still a lender, right? The Toshiba forklift company, right? Who will say, great, and here's a lease. But we also know if you don't pay it, we're going to come collect the forklift. And then, that's how they're going to, collateralize and protect that investment. And so I think, that's probably, where we see the most challenges, right? Is just, as these small business owners are getting used to these different challenges, right? They're having to think about the financing in a way they haven't had to before. And there are all kinds of different paths to launching an e-commerce business. Mm-hmm. Most people don't come to launch an e-commerce business with an incredibly deep finance and accounting background, right? Most people are coming to this from, they've got a product passion. They're passionate about pens or watches, or, hey, I love woodworking and I've got this array of woodworking products that I like to build. and accounting and finance is the necessary evil
Yeah.
for a lot of business owners, right? And so that's where we really try to step in and say, look, we're here to help you. We structure the product in a way that's designed to make sure that it works for your business. We're using data to drive that decisioning so that it's based on the realities of what your business is doing today. And we want to see you grow and scale, and we want to make sure that we're not, giving you too much money can also cause a problem because you can't pay it back. And then there's not more when you need it. And so what we're really trying to do is hyper optimize it for that specific portion of your business problem. And in doing so, that still leaves you open to go work with other lenders for other parts of those business financing challenges that aren't working capital related.
Mm-hmm. And speaking of growing and scaling, is there a specific time in a company's growth process that is most advantageous to consider lending? Is it go to market or a specific scaling stage, or does it really matter to you guys?
From our perspective, right, like we can't work with a brand new company because there's no sales history to go
Sure.
forecast. From my perspective, I'd say, look, you've got that 6 months worth of sales really going, right? We can then start working with you to forecast, and then we can start scaling with you, right? And that scaling is both going up and, post Christmas coming down. But if you don't borrow as much, you don't have this, the cost is less, so you're saving money. So, we really view it as we're hyper optimized to the needs of your business to help your business right this quarter, right? We're always kind of looking the next 12 weeks ahead for what your business needs for that 12-week period. And then, typically when you're halfway repaid, you can come get more, which means really 6 weeks from now, if things are taking off because you launched a new marketing program that really has hit a nerve with your retail customers, well, great. You can get more from us to adapt to that. And because we're seeing those same sales results, right, and the success of that, we're here to help with that.
Mm-hmm. No, and I totally get that and respect that. One of my final questions. I know you said obviously you don't invest in brands.
Right.
Have you come across one that you wanted to invest in instead of write them alone? You were just kind of like in a rock and a hard place a little bit.
I see a lot of businesses that I think have a lot of opportunity. And I certainly root for all of them. I will say this, I am so focused on making Onramp successful that I'm not really trying to go figure out how I do something other than Onramp, right?
Sure.
If I did see a business like that, I'm like, hey, look, I think it looks awesome and I'm rooting for you, but I'm not trying to go solve that problem because then, if we're not focused, we won't succeed. And if we don't succeed, then there's a lot of customers we'd be letting down.
Mm-hmm. And I heard you mention earlier that you obviously are trying to grow in this process as well. I think you mentioned that your loan range is between 1,000 to 400,000, and you want to kind of raise that cap a little bit and maybe play with some bigger dogs. So what does that look like for y'all? How are you able to do that? Is it stuff like this, more marketing, or what's your game plan for growing Onramp?
Yeah, no, look, we're trying to grow by continuing to support the small business owner. And, we have, when you're talking to the small business e-commerce owner, right, and you're marketing to that population, you get customers coming in that may be bigger than your target, but your marketing is still attracting their attention. And so we see that we have customers who need a larger capacity than we offer today. And what we're then looking at is how do we go support them, because they're coming to us anyway. So there is clearly a market need there. And so, our goals over 2023 and 24 are just to be able to increase that average advance size, be a number of different channels. There's a lot of different paths you can go do that, and be there to support those businesses. Now, I do think there's a natural point where a small business outgrows what we do. And I think that's when that small business gets big enough that they're hiring a CFO, a VP of finance, right? Somebody who really is focused on that side of the business. And, our guess is that happens somewhere between $5 and $20 million a year in revenue, because it's you just can't not, right? Like the business, as businesses get bigger, right, they demand more specialized personnel to run the different parts of the business. And when that happens, right, that CFO, that head of finance, when they come in, they're going to look at what we do and say, great, this is a hugely valuable tool, very worthwhile, but we think we could go to a bank and get a line of credit and really better optimize for the cost of capital. And at that point, from my perspective, that customer's graduated, right? They've reached that next scale in their business, right? And that next level of stability where they don't need us anymore. And so we're celebrating that win for them. Like, hey, that's an awesome day. We're not exactly expensive capital. We're not low cost capital, but when you actually look at what we do and the structure and the kind of the coaching we give, what you're really actually saving on is you don't need a CFO as soon, because we're doing that portion of it for you. And so that's part of what our cost is, right? Is helping to provide that. And so then, but when that CFO arrives, and we actually have companies where the CFO has arrived and they continue to use us, right? Because there is power in it. And others are like, great, thank you for getting us this far. Here's a great review. And now, we went to the bank and got a line of credit. And then, that bank line of credit isn't structured for payment terms, right? That CFO has to manage that. When do we draw and how much do we draw? And when should we start paying that back so that we're building up a balance that we can draw against again? And that takes time, right? There's a spreadsheet that's getting run, and there's a lot of investment in that team of people can do. But now you're paying those salaries, right? And until you're ready to pay those salaries, we're a far more affordable option.
Yeah, it's a delicate dance, and someone's got to manage that, whether that's you or a CFO or someone's got to do it at some point in time. The quicker, the better. Before we wrap up, I love this idea. I love talking with you, Eric. This is really cool stuff. Before we wrap up, I always ask from our guests this final question, essentially about how in the e-commerce industry, most entrepreneurs and professionals are operating minute by minute, round the clock, talking and thinking about e-commerce, their business, the networking, and all that sort of stuff. But I find that the most successful are often having a healthy work-life balance at the same time. So my question to you, Eric, is what hobbies and interests do you do in your free time to promote a healthy work-life balance?
Well, I'll say this. I hate work-life balance because it assumes that you have to be doing each equally.
Sure.
And so I like work-life harmony better. There are periods in your life.
That.
Yeah, there are periods in your life when it's time to go work really hard and roll up your sleeves, and the 18-hour days fly by and you don't even notice. And there are other periods of time where it's like, hold on, I need, there's other things in my life that I need to go do. And so it's finding the harmony of when's it time to do one or the other. I will say, what helps me relax and unwind is reading. And so I do that every night going to bed. That's kind of how I fall asleep. And it's a great way to kind of fill some time. And then if I can't sleep, I will then pick the book up again. And then I will try to have something very dry that will put me to sleep.
Nice.
My wife and I make it a point to spend time together every day. I try to be home for dinner every night with my family so I can get time with them and be a good dad. But I will say, one of the reasons that I was excited to start Onramp at this point in my life is I've got two high school kids who I wanted them to see how does an idea come from an idea in your mind to become a business, right? And so I started toying with how do we build Onramp in 2019 in my home office, where my son and daughter would, on the desk next to me, do their homework. And so they've actually seen the kind of the germination of an idea into, a spreadsheet, into PowerPoint decks to go raise money, into doing loans for the first time by hand, right? All the way to now where there's a company called Onramp, right, that has 26 employees and hundreds of customers and has done tens and tens of millions of dollars in loans, right? And so for me, there was actually a real psychic win to be able to share that with my family. But I do have to then turn it off, right? Because, they're not interested the same way I am.
I don't know. I think the imagery of all three of y'all working on your homework in the office, your homework's just a little bit more complicated than theirs is. I don't know. It depends
Right.
on if they're working on calculus or not. Um,
Their
look,
calculus is hard.
and that was my forte. I mean, that I was a math major in school, and then when the numbers started to become imaginary, like my senior year of college, I was like, I don't know if this is for me anymore. But look, Eric, it's been an absolute pleasure talking with you. I love your brand philosophy, the idea, the product. It all just seems really on the up and up. And I wish you a lot of success, my friend.
Thank you so much. I appreciate it.